right. Hello, everyone. This is Manay. Welcome to Manay Talks. I'm the CEO and the founder of Manay CPA. I have here now with me Thomas Rockwood from South State Bank. He is managing SBA relationships within the bank. Welcome, Thomas. How are you?
I'm doing very well. Thank you for having me.
Thank you. Would you like to please introduce yourself to our audience?
Sure, absolutely. So my name is Thomas Rockwood. I'm with South State, as you said, and I do SBA lending. I'm one of the SBA lending experts at the bank. We lend really across the entire United States, but our footprint at this bank is within the 7 states of the Southeast. I've been based in Georgia for almost 10 years now, and I've been in government-backed finance one way or another since 2003. So it's a fun niche to play in, and I'm happy to be here to answer any questions.
Awesome. Thomas is our go-to person whenever there's an SBA loan need for our clients. He also helped us buy our own building here in Atlanta as well. Okay, so can you tell us about the types of SBA loans? Because we're hearing, different types. I want you to clarify that
Sure.
for our audience, please.
Yeah, so there's 2 main loan programs through the SBA that most loan requests fall into. The 504 and then the 7A. So the 504 loan program is really for long-term fixed asset acquisition. So if you think real estate or long-term heavy machinery, that would typically fall in there, right? And so a bank partners with a local certified development company to provide that loan program, whereas the 7A loan program really is for everything that you can think of to benefit from a company, right? So working capital, inventory, equipment, machinery, all of the things, including acquisition of real estate. And so, the program is really which bank's going to offer the right solution for the borrower and which is in the advantage of the borrower and where can you get the approvals from. So most loan capital requests come from one of those 2 programs.
Okay, so who is eligible for these SBA loans? Let's talk about that now.
Yeah, it's a great question. So these are for-profit companies that are coming to seek capital for growth and expansion that are owned 51% or more by either a U.S. citizen or a lawful permanent resident alien or green card holder. And so, the company corporation type is either going to be properly a sole proprietorship or an LLC commonly or a corporation of some sort. And again, the ownership structure has to be 51% or more. The borrowing entity owns 51% or more by one of those 2 individuals, U.S. citizens or green card holders.
Okay. So S corporations, C corporations, LLCs, one member or multi-member LLCs, all would be eligible as long as they're for-profit.
Yeah, for-profit designation. Okay. So not-for-profit organizations aren't eligible for this loan program.
Okay. So what is the application process like? What types of documents you would need for the application or the common types of documentation? Let's talk about that.
Yeah. So depending on what you're trying to do is going to kick off various general kind of requirements of what's going to be needed, right? So I would advise a client who's looking to seek capital through the SBA programs, have a conversation with a lender first. That's going to really talk through a lot of what's going on, and based upon what you're trying to do, that'll just kind of determine what you're needing to provide. In general, if there's an existing company that is looking for capital, it's going to be 3 years tax returns from the company, 3 years tax returns for all owners of the company, 20% or more, interim financials, personal financial statements. It's not a short stack of documents.
Yes.
And the reason is we when we underwrite an SBA loan, we look at globally what's going on to make sure that it's all going to work. And it's really a thorough and in-depth credit analysis for the benefit of the client and the bank and the U.S. SBA. So, I look at eligible projects. Typically, someone's looking to grow and expand. It's a classic example. They're going to either open up a second location, or they're trying to do a business acquisition, or they're trying to buy additional equipment, or they're trying to restructure their balance sheet and do a debt restructure for one reason or another. And all those things are going to kick off various requirements. But financially, everything's going to need to be disclosed and shared.
Yeah, I remember you asking for my resume. So
Exactly.
It's going to be a very thorough application process, I'm sure. Okay. So what about a business plan or projections Do you need those for every SBA loan application?
Not every, that's a great question. So when there's a change of ownership or a massive expansion, it's typically when a bank's going to look at and say, hey, show me some projections. What's going to happen? Like, really, if there's massive change in the organizational structure or the operations of a company, we want to see what that's going to look like, right? The changes of expenses or revenues or any of those things really have an impact on the borrower's ability to repay the loan. So when historical financials can't be relied on, or they don't show the ability to pay the loan back because of X, then projections to explain what's happening to top line revenues, what's happening to expenses, and what that profitability is really going to be. And the assumptions that go with that is really when that's required.
Is that usually like about 5 years projections, or do you have any timeline there?
Yeah, it's a great question. So really we're looking at the first 24 months from the date of the loan application or the date of the funding. What's going to happen in that period of time? Companies can provide longer term visions, but projecting what's going to happen 3 years out is really tough. But you should hopefully know what's going to be changing in the next 3, 5, 12, 24 months.
Okay, gotcha. And what are the average interest rates for these loans, and how long does it take for the application process and how long does the application process usually take from start to end?
Sure, yeah. Interest rate structure is an interesting one. And in 2022, we started out at the year with prime being 3.25, and it looks like we're going to end it at 7.5, right? So interest rate structure is always a point of question. Typically, what the SBA says for a 7A loan, right, from an eligible pricing and interest rate structure model, they're going to take prime, the Wall Street Journal Prime Index, and then they're going to add a margin over the top of that. And the maximum eligible interest rate is 3% over prime. So at that point, I think if we look at 7.5 being prime today, then 10.5 is the maximum eligible commercially reasonable interest rate that the SBA would allow. On the floor of that, it's really up to the lender to kind of say, okay, prime plus 3, or is it going to be prime plus 2, or is it going to be prime plus 1.5? What does it look like? That's going to vary between bank to bank to bank. And that's going to be a function of risk, right? So what are we trying to do? What's the collateral? What's the cash flow? How long have owners been doing this? That kind of stuff. So an assessment of risk really drives interest rate, but that structure is what's pretty common in the market. On the 504 side, the commercial bank is going to really set the first mortgage rate. So whatever they would normally do is probably what you're going to get on that first mortgage structure. And then every month, the SBA 504 SBA portion, that gets set. And so that fluctuates with the 10-year treasury at this point. So as the 10-year treasury goes up, that goes up and down as well, similar to the Wall Street Journal Prime. But the benefit to the 504 program is that there typically are fixed rate options there for the 504 first and then for the SBA portion. Right,
and those fixed rates right now, what is the range?
On the SBA debenture side, it's in the mid 6s currently. And that changes. So if the 10-year treasury goes up, that goes up. If it goes down, it goes down.
Could change, any minute.
Yeah, exactly. So banks are setting those rates on the first mortgage for fixed interest rates as well, based upon their cost of funds and what's going on in the market. So depending on when you close and when that debenture funds really does set the interest rate.
Right. Okay, so how much of a credit score is needed to apply? Are personal or business credit histories being checked in the loan process?
Yeah, that's a great question, and it's a very common question. So yes, the personal credit reports of guarantors, anybody that typically owns 20% or more of the company, those will be pulled. Business credit reports, those will be analyzed along with all the business financials. When it comes to the score, my kind of general philosophy is the score is an indicator of what's going on, and so the question is what's going on, right? If there are collection accounts or if there's derogatory history or payment history, those are going to affect score, and that's really up to the bank to then look at that and say, what are the issues? Has it been resolved? Is it mitigated? Is it going to continue? Those sorts of things. So a score is just an indication of what's gone on in the past up to that point. And so all of that comes into consideration. But there are mitigating circumstances to then say, hey, this is what happened, this is why, and so press forward. And that's really a credit call. On small loans, the SBA has their own scoring model, and so there's not a credit score number that I can predict that on a personal credit report that then tells me if it's going to pass. But on small loan requests, what lenders do is they enter in the information into the SBA system, and then that kicks out either passing or not passing score, and that's an approval for small loans. But situations vary, and I would say that I've seen loans get approved or declined with various reasons over the years. Credit score is just an indication of what's going on, and I think any applicant should kind of know their score going in and understand what has happened, and be able to explain if there is any kind of derogatory history.
Right. Okay. Can you give us an example of the cash flow requirements for a project to be approved by SBA?
Yeah. So the short version is, the company has to be able to show historically or going forward that it can pay the loan back. Otherwise, it's not prudent to make the loan. The minimum score of the SBA's requirement is 1.15 debt service coverage ratio. So the way I think of it is, if you have $1 to pay the loan back, for every dollar you're going to borrow, you need to have $1.15 to pay the loan back, right? And that's a really tight margin if you think about it. But essentially, if you don't have it historically, you're going to have to show in projections that you have it going forward and why that's going to happen. There's going to be tangible evidence that says, this is what's changing, here's what's going to happen, I can pay this loan back. And that's really what a credit decision from a cash flow perspective is based on. Show that you can pay the loan back and show that those things are going to really happen. Every bank's going to have their own appetite. Bank to bank to bank, they can say, well, 1.15 is pretty tight. I don't like that. I want something different. And obviously, the bigger that number is, if you have $2 in cash for every dollar in debt, that's a 2 times coverage. Then that's a better position, stronger position to be in. So the stronger that number is, the easier from a cash flow perspective that it's going to be for that company to make that loan payment.
Right. Okay, great. And what are the common reasons for applications to get rejected?
We can start with either it's not for an eligible purpose, right? If it's not eligible, it's not going anywhere.
Okay.
So it has to be within the definition of SBA eligible. The other component is it has to show that it can cash flow, right? And so if it doesn't show that it can cash flow, it being the request, that would be the reason for decline. After that, it really comes down to the assumptions, right? Is it going to happen? If you think about, a startup company, right? There's no historical cash flow. There's no guarantee that it's going to happen. There's no customers that are there lined up to say that you're going to have top line revenue. So what are all those assumptions is a bank willing to take that risk with a company to provide that? And so it's more of a relationship conversation. If it's an eligible request and it shows that it can cash flow, it comes down to what else is going on. Right. But those are the primary drivers. If it's not eligible and if it doesn't cash flow, it's not going to get approved.
Right. Can you tell us how many times one can apply for an SBA loan after getting rejected? Or is there a limit on that? Or
yes and no. So on a delegated basis, depending on the bank you're working with, right? You can say, okay, I've got this request, and for whatever reason, it's not going to get approved today. Right? Understand why. Right? The why is the really important piece. And once you feel like you've accomplished mitigating that or resolved that why, then I think it's prudent to go back and try again. The lender, if they submit the application directly to the SBA, there is a limit to the number of times that they can send that request on behalf of the borrower to the SBA to review within a 6-month period. And so, if the SBA directly declines the loan for one reason or another, there's a process to then say, but, can you reconsider this? What about this? And then if a final decision is to decline, time must pass. And eventually, you have to resolve those issues. But I would say it starts with working with your bank. And if you get a decline or you get a not now, then the question is why and when, right? So if it's, kind of go back to my original kind of example, if it's a startup, what was going on? Did you have the right assumptions, or did the market conditions change, or what happened to resolve the issue? And if that's been addressed, then I would say it's time to have another conversation.
Good. And how many SBA loans can you get at the same time? Is there any restrictions on that?
That's a great question. So, to the benefit of the borrower, you're not going to want to go through this process every month, right?
Right.
So, if you project out, okay, hey, this is what I'm doing. I've got this vision I want to encompass a loan request with, and I want to make this happen. Great. You close that loan, time passes, and there's not a specific amount of time, but you say, okay, now I want to do this, or there's another opportunity to do something different, right? Or I got another acquisition, or I need to buy this over here. There's no requirement that says, X number of months has to pass between applications. The big driver is the amount of guaranteed funds that any one company or any one owner can actually have, right? And so there's a $5 million maximum guaranteed amount that any one business owner can have, right? So if you are saying, hey, I've got a $500,000 loan I closed last month, I've got a new opportunity, I want to borrow another $500,000, absolutely. And really it's up to $5 million for that company and or the owners of that company to benefit from SBA loan programs. Does that make sense?
Yes, that makes perfect sense. Okay, so the upper limit is 5 million. We're going to have to stay in that limit. Okay.
Correct.
So the maximum SBA loan amount for any project or in combined, I guess, would be $5 million.
Correct.
Could it be possible to combine an SBA loan with other loans if the loan amount does not cover the investment fully?
Yeah, absolutely. That's a great question. So, depending on what the project is, if you've got a $8 million project, right, the SBA portion can be up to $5 million. And there's a way to do a 504 and a 7A to encompass that
At the same time,
if there's eligible proceeds going towards purchase of those long-term fixed assets. And so there's a way to structure a real estate or the fixed asset acquisition in addition to through the 504, in addition to the 7A, to then actually get more capital, right? Access to capital that's needed for larger projects. Case by case, you're going to want to talk to the lender you're working with and kind of say, okay, how to best structure. But yeah, the SBA's requirement is that it will only guarantee up to $5 million. And so organizing your 7A structure first and then coordinating with a 504 structure for a second loan to acquire the balance of that larger project, absolutely doable and definitely something case-by-case scenario to structure with the lender.
Got you. Okay, and regarding funds used according to the loan borrowed and industry, any important restrictions or regulations to know there?
Yeah, there are some industry restrictions, but for the most part, most businesses, are going to be eligible to receive those funds. So if you drive down the street, what you're looking at through Main Street America and in corporations and industrial parks, those are all there. There's size requirements from an eligibility standpoint. There's some industry requirements from an eligibility point. So back to that eligibility determination, it really does start with a conversation. Hey, this is what my company does. This is what I'm trying to do. Here's who owns the company. All of those things. That's an easy conversation to have with an SBA lender to say, does this sound like we're heading the right direction for an eligible loan request? And if so, what's your application process?
And also for one, I can also add to this is when you get in real estate, you need to be occupying 51% of the real estate.
Correct.
As the business that's getting the loan. So, and if you're maybe planning on renting the whole facility after getting an SBA loan, that wouldn't be possible, but you can still rent out 49% of the. You can still rent out the 49% of the facility.
Right. Yeah, if it's real estate acquisition as opposed to construction, though that percentage changes slightly, but for the most part, you're 100% correct. Okay. Loan proceeds can be used to acquire real estate, right? Mm-hmm. And 51% owner occupied is the minimum requirement. Mm-hmm. So as long as you're owning and occupying that, you can acquire that real estate. The company has to be able to show cash flows. And so one of the things we can't do in our underwriting process is really rely on rental income. So, again, talking through that with a lender is important, but you are correct. When it comes to the real estate portion, if SBA proceeds are going to be used, the operating company or controlled companies by the owners really need to occupy 51%.
Okay, perfect. So that brings me to my next question, actually. Let's talk about the asset-based loans. Could you inform us about acquiring a commercial real estate property with the SBA loan? What components are different there?
Sure. Yeah, so in the 504 program is a great example of this. The SBA is going to have a portion, the bank's going to have a portion, and then the equity, cash injection, or down payment is going to be a portion. And so that typically that starts at a 10% cash injection on a total project. the bank's going to fund or end up with 50% of the loan, and then 40% is going to be the SBA. And there's some kickers to then say, okay, the SBA's portion is going to be smaller and cash is going to need to go up. So for example, if it's new business or if it's an owner that doesn't have a lot of experience running this type of business, so therefore newer, that might be a 5% increase to cash injection. Mm-hmm. If it's a special use property, that is going to be a 5% increase to cash injection. So somewhere between a 10% capital injection to 20% capital injection is where that's going to end up. It'll be in that 5% increase mark. Mm-hmm. And then the SBA portion will either be 40, 35, or 30% of the project. And then the bank's going to have half the project. And that's really, when we're looking at long-term fixed assets, that capital injection requirement that's going to be in there. On the SBA 7A side, it's a little bit different. There's not necessarily a cash injection requirement on acquisition of real estate. And so, some sort of, cash towards the project is prudent, mm-hmm. especially considering closing costs and fees, but that's more flexible.
Could be 0%.
That's going to be a lender by lender position. Okay. Not necessarily advisable, but right. Depending on what you're doing and what the situation is, there are ways to look at it in different ways, right? So if there's built-in equity or there's something else someplace, it really comes down to, and that's a very specific situation and a conversation with the lender. Mm-hmm. But the 504 program is going to have a 10, 15, or 20% project, where on the 7A side, it might be less, right? Mm-hmm. And I've seen it be less than the 10%.
What is the least you saw? What is the least percentage you see? Before?
Sure, yeah. So, someone who covers the fees and closing costs, right. Typically, that way they're not upside down, but that, on the asset perspective, mm-hmm. I've seen it so that, they're pretty leveraged on the actual tangible net worth of the asset. Okay. 2, 3, 4, 5, sure, right?
Okay, that sounds good. Okay, let's talk about how about starting a new business, mm-hmm. Or buying a franchise with SBA funds. How do you evaluate a new business? There's no, records.
Absolutely, that's a tough scenario to be into, right? So when you look at it, you're always at every SBA loan, you're always looking at the guarantor's expertise and their ability, right? You look at the feasibility of the project. So this is a startup project. Does it have tangible projections and assumptions that go with that say, yeah, this is going to happen? Mm-hmm. You bring up franchises. Franchises typically help mitigate some of those questions of, is this going to happen? And is there a model for success? Right? And so the franchise has experience, and they have other franchisees in other locations and similar markets, similar geographics, and similar demographics. The company should perform similarly. Right? And if someone's got the background and expertise in that industry, then they'd be a good candidate to continue to run that kind of a company. And so when you're looking at startups, you're looking at all of those factors, right? What's the capital injection going to be? What's the cash flow going to be? Is there outside income to support that loan request? Is there outside income to support the household of the owner, right? To continue those, right? So all of those factors come into to play to really say, is this a good situation? Mm-hmm. Personally, I don't think it's advisable to be all in on one thing in must-work scenarios. Mm-hmm. It's a hard place to be, right? So, I always advise entrepreneurs have excess capital, right? Beyond what you're putting in the project, what else do you have in savings, right? You don't want to be 100% injected into this and not have anything left. Mm-hmm. Likewise, how you're going to continue to pay for living expenses while the company's starting up, right? And a lot of startups have construction or renovations or leasehold improvements. So there's a period of time that your money's all in and you're not getting any salaries or getting any revenue. So how did that get addressed? So all of those things really are contemplated and discussed in detail. It's a very thorough process, but I would say that when somebody gets an SBA loan, it's done prudently and it's done correctly. Mm-hmm. And so all those factors have been addressed. So the more that the entrepreneur can come and say, hey, I've got a plan for all of these things, and here's the scenario, the stronger the loan request is.
Mm-hmm. Okay, got you. Do banks or SBA require any collateral or personal guarantees in these situations?
Yep, absolutely. That's a great question. It's definitely a hot button item is collateral and guarantees. Right. So the guarantees really start with whoever is going to be a 20% or more owner of a company will be considered a guarantor by the bank on the loan request. They're the ones who are going to be providing personal financial statements themselves, along with tax returns, and their assets are going to be looked at. So the business it's going to pledge collateral that it has available to the loan. Anything that the SBA loan is going to fund, that is going to be pledged as collateral to the loan, and based upon a liquidated basis. So if you say, okay, I'm going to buy real estate, well, it's got a margin value. So even if you're putting in some cash, right, it might be unsecured still, right, based upon whatever the project is. So if it's still unsecured, then they're going to look to, the banks and the SBA is going to require us to look to the assets of the owners. And if there's equity in tangible assets of the guarantors, that will oftentimes be pledged. Great example is, you've got equity in a home, right? That equity of your personal residence, that could be considered as a requirement to be pledged by the SBA. That gets a little bit touchy sometimes when you have spouses and other people to consider as well that have ownership on title, right, in those assets. So all of those things need to really be discussed on the front end and laid out. But personal assets can be a requirement if the cash injection is not there to the project, or if the assets of the company don't fully secure the loan.
So we talked about SBA loans, but I want to also cover a little bit of on conventional loans. So what are the main differences between SBA loans and conventional loans?
That's a great question. So a conventional loan, generically speaking, is a loan that fits a bank's loan policy, right? Loan policy really kind of touches on collateral, cash flow of the company, the owners of the company, the conditions, the environment, the business industry, all of those factors that come in. And if it fits the conventional loan policy, the bank's conventional loan policy, it should be done that way, right? In the SBA programs, I kind of think of it as a bullseye. That's the center of the bullseye, right? When a commercial client has a request, they're coming in and saying, this is what I want to do. If it fits conventional loan policy, that's where it should be done. If it doesn't fit conventional loan policy, or you get a decline for some reason, and a classic example is collateral, right? So if what you're doing doesn't meet the collateral requirements of a bank, that might go out to an SBA loan request, right? SBA takes collateral that's available because that's prudent, but it's not a condition, or it's not a reason for declining a loan if there's not enough collateral to support the request. So that's a classic example of kind of how the SBA provides that extra layer of access to capital that might not fit within that conventional loan policy. And so, a loan request comes to a bank and they say, okay, does it work? Can it work? It should go to, and essentially say, is there credit elsewhere to have this done? And if the answer is no, there's no credit elsewhere of the owners, there's no credit elsewhere of the company, then it's eligible for the SBA. And that's where we get more yeses typically from that respect. Does that make sense?
Yes, absolutely. You talked about briefly on the down payment requirements for SBA loans or conventional loans. I'm sure there are some big differences there, but can you just rephrase that?
Sure.
The down payment requirements, so that's clear.
Yeah. So on conventional loan, this is going to vary bank to bank to bank and what their loan policy says. But let's just say the standard conventional loan is going to require 20% cash injection plus the closing costs for the piece of real estate that's going to be owner occupied. The SBA's programs would require 10% of the total project, right, through the 504 if that was eligible that way. And so the cash injections on SBA loans are typically less. And where's that cash coming from? Right? It's typically coming from the business or its owners. And so as we talked about before, having equity or having post-transaction liquidity is important. Putting all of your working capital into a fixed asset acquisition may not be in the best interest of the company. And so, access to capital through lower cash injections is a benefit to the company and its operations ongoing. So that's kind of where the differences are. Again, the structure is different, the fees are different. And so somebody who's looking at that says, okay, if it works and it's more advantageous to do a conventional loan, they should absolutely do that. But if that doesn't work for one reason or another, they don't have enough extra cash to put into the project, they don't have that additional funds, that's where lower cash injections on the SBA side benefit the operations of the company in the long run and its owners.
Gotcha. Okay. Let's talk about international clientele.
Yeah.
So we have a lot of those in our client portfolio. So how does it work for international clients? Can you tell us about foreign-owned businesses, if they can be qualified for SBA loans?
Sure. In general, as we kind of talked about before, companies that are seeking have to be for-profit companies, and the owners of those companies need to be U.S. citizens or lawful permanent resident aliens or green card holders. So if 51% of the company is owned by either a U.S. citizen or a green card holder, right, then the request is eligible, assuming it meets all the use of proceeds eligibility and everything else. So a company that's owned by a foreign person or a foreign entity doesn't meet that requirement, typically is not going to be eligible. Mm-hmm. And so, as a foreign company or a foreign-owned company is looking to get access to capital through the SBA, it really does need to start out with that basic eligibility requirement. Is how will the company or how will the loan request meet that first tier requirement, right? Mm-hmm. For the benefit of U.S. operations is another key component. Mm-hmm. So companies that are seeking capital, whether they're foreign or in the United States, it has to benefit U.S. operations only.
Right.
So you can't be saying, hey, we're going to start up a new location in a foreign country without it really being for the purpose of U.S. operations. Does that make sense?
Yes.
Yeah.
So the business has to be solely operating in the United States. That's going to be really using the funds.
The business can operate in multiple countries, but the use of proceeds for the SBA loan has to be for the benefit of U.S. operations.
Okay. So the business can be operating all over the world,
yeah.
but the proceeds of the loans has to be used in the United States.
Yes.
Okay.
So, I'd like to think of a distribution company, right? So they're taking their products and they're warehousing them and they're shipping them out to mm-hmm. Retailers around the world, right? Or they have different distribution facilities around the world, right? Loan proceeds would be from SBA purposes, would be for the benefit of the U.S. distribution centers and in their operations there. So you can't buy real estate, you can't go to support operating expenses of foreign locations, but we can for the U.S. locations.
Right, okay. And if the company is owned by another international company, not a USA-based company, or if the company is owned by a non-US citizen individual, they would not be eligible for a loan within the SBA. I just want to re-emphasize that.
It's a great question. So, what we're required to do is go down to then document 100% ownership of the borrowing entity and or its parent companies that own it, right? So if you have a subsidiary company here in the United States, we have to get to individuals that own 100% of that company, and we need to understand that 51% of those individuals, mm-hmm. getting to the person, are of the status of U.S. citizen or lawful permanent resident alien.
Okay, and that would also mean maybe the same thing for the U.S. based. Like if a U.S. based company is applying for a loan and this U.S. based company is owned by another U.S. based company, you will still need to get to the individual who owns that other U.S. based company. Correct. Like,
we go all the way down to the individual owner. So okay. Yeah, if the borrowing entity is owned by a parent company. Mm-hmm. That parent company is analyzed, and we have to have financials there, and we have to understand who the ownership of that is. So mm-hmm. we typically see organizational documents, and we get all of the filings to document organizations and who owns what, mm-hmm. down to 100% individual ownership.
Okay, perfect. Okay, can you give us any tips for a successful application process?
I like to start with the end in mind, right? So, have a conversation with a lender and say, okay, this is how I see loan proceeds being dispersed. And how are you going to document the disbursement of those proceeds? Where are the invoices, the receipts? Like, what is that going to look like? Right? Because then you can backtrack from there and say, okay, well, how do you get the documentation to support that? And how is that going to make sure that it's eligible use of proceeds? And then who's going to own it and go from there? So there's a lot of moving parts, but I would say who you talk to and the information you're getting from an SBA lender is important. Their expertise and their knowledge to be able to walk you through the process is going to be important. But it comes down to SBA loans are purpose driven, right? And every dollar is documented. And so knowing what you're going to do with proceeds specifically is important. Mm-hmm. Being able to then back that up with the right documentation is very important in all the details. So.
Yeah, and you do that, right? Like if a client comes to you, tells you about the project, or even if it's an idea, maybe you can just steer them Correct. Through the right direction.
Yeah, I take a kind of a very initial consultative approach, right? Mm-hmm. Saying, okay, nice to meet you. How's this, what are you trying to do? Let's get into the weeds of that. How's this going to benefit the company? What's the long-term vision, right? Who owns that entity? who are the owners, the key employees, who are the directors, what does the company do, right? What kind of revenues does it have? What kind of employee sizes are there? All of those factors. It's an easy conversation to have to then map out, okay, this is either going to be eligible or this is not going to work, and let's try to get you access to capital through a different solution somewhere. What I have found true about all entrepreneurs is they are going to make it happen one way or the other, right?
Yeah,
and so that passion and drive is really what inspires me on a regular basis. And so I like to help say, okay, this isn't going to be SBA eligible. However, here's some other options to consider, or here's other people that you might talk to, right? That they can help you get it done. And that's the key. But if it's SBA eligible, and if it's something that can be done, I'm always willing to help and excited to help clients get access to that capital, to see them grow and expand and truly change the faces of our communities and provide the prosperity to their employees. And this is how people put food on the table and put roofs over their heads and send their kids to college. And so it's an exciting process for all involved. And we all want yeses, especially the entrepreneurs. And so how do you get those yeses is really the driving question.
Yes. Well, thank you so much for your contribution. I really enjoyed our conversation. I hope our clients, our audience also can benefit from it. We appreciate it. Please come back again.
Absolutely. Thank you for having me. It's been an honor, and happy to help in any way I can.
Thank you. Thank you for listening, everyone. Please subscribe. We'll see you next time.